Hello, everyone. Welcome to Invest 2030. This is an education series aiming at creating awareness among Swiss asset managers and institutional investors regarding the range of impact investing products that are currently available across multiple asset classes, sectors, and geographies. And it is part of the Building Bridges community. Building Bridges is a flagship event taking place in October in Geneva, but it's also a year-long activity of creating partnerships for financial innovation and to help mobilize capital for the SDGs. So today our webinar is focused on biodiversity, and my thanks to the four product managers who agreed to present their products. During this call, we'll have 4 presentations, each of about 7 to 10 minutes. And at the end, we'll have time for Q&A. During the presentations, feel free to share your questions through the chat, and we'll try to address them as much as possible in the hour that we have. And of course, my thanks as well to Phoenix Capital for helping us shortlist the products and screen them together with the volunteer screening committee of Invest 2030. So without further ado, let's get started. And the first presentation will be from Carlota, I believe. Carlota, you have the floor.
Hello, hi team. Hello, everyone. Thank you for giving us the opportunity to introduce the Green Fund today. Maybe I will start with a brief intro on myself. Carlota, Head of Investor Relations and Fundraising of Cell Ventures, which is a deep impact investment manager. More specifically, I lead the IR and fundraising efforts for its first investment mandate, the Green Fund, which I will tell you about today. If we move to the next slide. Green is a blended private debt finance vehicle, which aims to make a high impact from a climate change perspective, specifically on land use and zero deforestation. Our thesis is to prove that financing sustainable and deforestation-free commodity supply chain production can be done commercially and replicably. We're trying to do so by catalyzing more than $1 billion in investments to protect, restore, and conserve tropical forest. Our structure is blended. That only means that we invite both public and commercial investors into the mix. The public investors acting as first loss to attract commercial investors. And our geographic focus are the tropic regions, as in our view, they have the biggest natural climate mitigation potential, as they store 60% of global carbon content. And within the geography, what we do is that we look at the sectors and the commodity production that are the reasons or the causes of deforestation. For example, in Brazil, it could be cattle, but maybe in Vietnam, it could be coffee, for example. So what we do is we then look for those industry influencers to finance them to help transition the industry, in my example, cattle or coffee, to no deforestation. The fund so far has raised 180 million and aims to scale to 1 billion in the next decade, and has invested in 7 companies so far, and total assets under management of 146 million. And next slide. So how do we actually, lead this transition of sustainable deforestation-free commodity supply chains? What we do is we invest via long-term instruments, debt, that's important, debt instruments, and we don't invest in the input or the commodity per se. We invest in an aggregator to absorb our financing and push our commitment. That means that our clients, can be producers, processors, even financial institutions, although we haven't invested in any so far. And the reason behind this is that we believe that larger, more influential companies have more control over the supply chain. As I was saying, our investments are long-term, typically 8 years, can range up to 15, ticket sizes of 10 to 20 to 50 million, and we get paid for our loans an average interest rate between 6 to 9%. Financial covenants of our loans are, the usual prospects, so collaterals, etc. But most importantly, and to differentiate ourselves from, traditional financial institutions, we do embed in our loans ESG covenants that the clients need to comply with throughout the investment period. If not, the loan can be called back. On the ESG covenant specifically, among multiple things, one thing we do is we design a landscape protection plan with the client that includes both direct and indirect suppliers, and which outlines specific milestones that the client needs to comply with in order to overall comply with the IFC performance standards. They also need to comply with a biodiversity framework. They also need to comply with a gender framework. And if there's certification of the specific commodity, that will also be part of the ESG covenant. If we move to the next slide, you will see some examples of the companies we have invested on so far that match our previous investment criteria. As I said at the beginning, we have invested 146 million in 3 jurisdictions so far, in cattle, palm oil, rubber, and grains. And it's important to note that given that we want our investments to be scalable and replicable, we do invest in either larger scale clients via an unsecured product, for instance, Marfrig, which is the second largest meat producer globally, or we invest in influential actors that if we think are riskier, we will secure the loan via strong collaterals, because we think these actors can, as I said at the beginning, act as blueprints for other players to follow. And we've seen it already with some of our investments. Their competition has come to us asking for a similar financing package. The next slide talks about our impact. How do we measure it? How do we monitor it? If we move to the next slide. So in the end, our target as a fund is transforming these industries and proving that deforestation-free production can be done commercially viable and replicably. So we, of course, do it via KPIs, and we report them transparently in our website and in annual reports. I'm happy to go through the KPIs later in the Q&A. The monitoring of the KPIs and of our impact is done via numerous ways. First of all, we have in-house satellite monitoring. We actually find out fire on one of our investees before the client even did so. We review second-party annual financial and ESG reports. We do quarterly review on the action plan that we set on the ESG covenants. And as mentioned, the KPIs are monitored and transparently reported in our annual report and website. Moving on to the next slide is the liability slide. So who is involved so far? Who finances? We have raised 180 million from catalytic investors mainly. So NICFI, Norwegian government, Unilever through their foundation, UK government via BASE, and FMO, the Dutch finance institution, and this group of climate finance donors and corporates have provided patient capital to be blended with the private sector funds to combat climate change. This takes me to my last slide that talks about the green investment opportunity. The fund, as I said a couple of times, is aiming to scale up to 1 billion in the next decade. And our next phase includes fundraise to blend the catalytic capital that I just talked about. We aim to raise the money via numerous tranches. The first one would be 250 million. The minimum ticket size is 25. The instrument is going to be a note with a 10-year tenor, and we target returns of 6%. Not only that, thanks to the blended structure, this investment will have 100% cover in case of default from the catalytic investors. And not only financially, but impact-wise. I would like to mention that a strategy like this one would enable investors to diversify into secure emerging market lenders, access land use agricultural investments, be part of the climate transition, specifically of the food agri-transition. We have a global pipeline and a dedicated fund manager, Cell Ventures, which has a team specialized in both, ESG and finance, and has a very strong network of partners in the ground, DFIs, governments, and hopefully institutional investors very soon. And of course, an investment for Green, just visually, just 25 million contribution will protect 400,000 hectares of forest, benefit 12,000 households, and have a 6 million emission benefits. And with that, the next slide just shows my contact details. I will wrap up my presentation now, and I'm very happy to take any questions later. Thank you.
Thank you very much, Carlota. That was an excellent presentation. And again, for those of you on the call, please feel free to write your questions in the chat so that we can address them later during the Q&A. I certainly would have one, Carlota, on verification. Obviously, I think that might be present on the minds of a number of the investors. How do you actually verify the impact, the do no harm, first of all, and then the do good? That would be interesting. Next on the presentation is Joseph. Joseph, you have the floor.
Thank you, Tim. Hello, everyone. Joseph Oriol, managing partner of Okavango Capital. As the slide says, we back businesses that have positive impact on natural capital and rural livelihoods, and by extension, obviously, on climate change mitigation and adaptation. We've been around for a few years. We've tested our approach, which is very focused on biodiversity conservation and linking natural capital to both climate and sustainable development, and tested through individual investments. That includes sort of one of Africa's most successful forest carbon developers, tourism operator in the Greater Serengeti, which have reinforced the notion for us and the conviction that you can deliver good returns for investors while delivering impact at scale, as these businesses have done. We also do manage a sort of a small impact debt portfolio that was set up by our technical partners, the African Wildlife Foundation, and my partner Charles Davis. But what we're talking about today is Okavango Fund. You'll see in the next slide is a $75 million equity and mezzanine fund, structured as a GPLP Luxembourg vehicle, all very sort of standard, seeking to provide risk-adjusted returns, making 10 investments in growth businesses across 3 main themes that are obviously very relevant for both climate and natural capital conservation. These themes are sustainable agriculture, regenerative agro, and food security. And the second theme, what we call catalytic technology. This doesn't only include things like a transition, companies that help reduce the dependency on wood and charcoal as sources of energy, but also technologies that help us manage our relationship with natural capital better, from managing water, soil health, reducing people's vulnerability to climate, drought, floods, etc. The third theme is what we call natural capital services, which include the typical ecosystem services like carbon or biodiversity credits or water, but also some of the services that are produced in these key ecosystems of Africa, for example, forest products or nature-based tourism. We aim to have a first close at 40. Target is sometime in the next quarter, We have two anchor investors in the form of the European Investment Bank and the UK's FSD Africa. FSD has provided also a blended instrument as well for private investors that provides 50% cover up to the amount of their commitment. And our thesis in this sense, very much linking the type of investments that we make and the type of companies we make, having a strategic advantage, both in a reduction of the risk that is associated with the dependency on nature and climate, and also the efficiencies that come from making investments that are going to make them more profitable and more resilient. The next slide shows you our team. Basically, what's perhaps unique in this time when you find a lot of climate and nature-related funds is that we've been doing this for a long time. We have a unique mix of decades of experience in both growth investments across multiple sectors, using private equity structures, particularly in Africa, but also pioneering financial work around conservation, biodiversity, and nature-related investments, from innovations around private conservancies that had multi-layer revenue streams and became profitable, to leading carbon offset developers, etc. You will see there's an investment director here without a face. We have identified a very, very good a professional Kenyan lady, but we cannot disclose the name at this time. And in addition, we have a group of advisors, including one of the founders, who are very senior, ex-CEOs of DFIs, like chief investment officers of large emerging markets, private equity companies, who will help us not only in governance, but also bringing expertise. If you go to the next slide, the theme that we're touching on is particularly dear to us because it's sort of now becoming more obvious to the market, but we've been banging the door for years. And the fact that in Africa in particular, and our focus is East and Southern Africa, climate emissions are very, very intrinsically linked to nature. We have almost 60% of the emissions come from the damage, deforestation and degradation and land use change of Africa's key ecosystems. Africa is unique in that its ecosystems are massive in scale, both in area and biodiversity levels, but also because of the megafauna that would not be able to survive without these large levels of connectivity. And this is under substantial threat because we have a very fast growing population that's increasing their income, and obviously 600 million rural Africans who depend on nature for their livelihoods who are trying to catch up. They are serving mostly a domestic demand for wood as fuel, for food products, particularly protein. Protein is about to triple to quadruple in size in terms of market in Africa, and that excludes exports. And the potential for damage is massive. Obviously, the potential for doing things right and the opportunity for good investments is very large. How do we do this? If you go to the next slide, there's a very simple description. We have plenty of slides if any of you want to continue the discussion later on, but we've simplified it. Obviously, we will do everything that a normal equity and mezzanine investor in emerging markets would do from a commercial point of view. So we will look at all the fundamentals of a business. But in addition, we've developed a proprietary filtering system to identify the key investment parameters in terms of impact. We've developed this in partnership with our technical partner, the African Wildlife Foundation, and we look at what these businesses do. We measure them around 49 key indicators, not only ESG, but also impact. And then we map the value chains against Africa's most important ecosystems. We define these by a combination of metrics from biodiversity, presence of charismatic species, connectivity, tree cover, deforestation threat, water security, presence of human poverty, indigenous rights, etc. And then we identify levers of impact. in each of these businesses where we can potentially add a lot of value. If you go to the next slide, I'll give you one example. We have another, but we'll just give you one. This is Project Nyala is a very interesting company because they work with smallholder farmers. Most of them farm crops like tea, coffee, or fruits. They have small land holdings. They work very hard, and this company works with them, around 8,000 of them, give or take 50,000, 40 to 50,000 beneficiaries in East African countries. And they intercrop a export spice commodity that then they train the farmers to grow, they process and sell in international markets. They have a massive amount of demand. Their main problem is securing supply and standardizing quality. They seem to have cracked that nut. They're growing like wildfire. They're growing very fast, and they are increasing farmer income by 30 to 40% without having to expand the farming. So no more deforestation, no more damage to the ecosystems. And when we map this company, most of these farmers are a buffer zone around some of the region's most important and most threatened forests, original forests. And they're expanding into even more important ones, potentially on the coast, where the forest cover is fundamental for the conservation of coastal mangroves and the ecosystem. The next slide basically just will show you, well, if you jump, this one we're not going to talk about. The next one just shows you some of our ambitious goals, our companies. So go to the next one. And, you know, our companies have already protected, or the ones that we've invested protect millions of hectares of biodiversity rich landscapes, benefit over 1 million people, protect hundreds of millions of trees, and have avoided millions of emissions. But we're ambitious. We want to expand on that. So I'll leave it here. The next line has my contacts, and of course, happy to answer any questions later on and to continue the discussion at a later date. Thank you.
Thank you very much, Josep. Also an interesting presentation on the potential and the challenges in Africa. I noticed that one of your investors is the IB, so perhaps in the Q&A you can tell us a little bit more about their role in this fund and the reason they invested. Thanks. So moving on to our next presenter, that is Alessia. Alessia, please, the floor is yours.
Great, thank you. Hi, good afternoon, everyone. My name is Alessia, and I'm a part of SLM Partners. We are a specialist real assets manager investing in regenerative land systems. First slide, please. So out of all the habitable land on Earth, 50% of it is dedicated to agriculture, and another 37% is dedicated to forests, some natural forests, some managed forests. At SLM, we focus on these two land systems, agriculture and managed forests. And it's really all about the how these systems are being managed. Today, most of the large-scale agriculture and forestry is under conventional management, which is highly reliant on fossil fuels, chemical fertilizers, pesticides, which degrades soils and harms biodiversity. So our mission at SLM is to scale up more sustainable forms of land management. So our ambition is to be first regenerative, seeking a positive impact on soil health, carbon, biodiversity, and being strategic about water usage. Two, to be resilient, thinking about how we can improve resiliency to climate change, because it's only going to get harder. And two, be competitive. How can we keep the land productive to grow crops and materials that we need and offer attractive risk returns for investors? So the way that we work is that we start off by identifying farmers and foresters that we want to work with, where philosophies are aligned. And then we provide the capital to buy land and plant trees for them to grow their operations. Our investors benefit from the income that is generated through the sale of what is being produced on the land, and also the capital appreciation of the land itself. So we've been around since 2009. On the next slide, you can see what we've been up to so far. So we started out in Australia doing grass-fed beef and carbon projects. We are also very present in the US, where we are helping organic farmers grow by offering them long-term flexible leases. And since 2018, we've been doing forestry in Ireland. So this fund was set up with the support of the EIB, and it is the first fund promoting continuous cover forestry in Ireland. So this is a way of managing the forest that has a lot of environmental benefits compared to traditional clear felling management, because we never remove all the trees at once. We only harvest the trees gradually, which makes the whole thing look and feel a lot more like a natural forest and provides a steadier stream of cash flows. So this fund has had a lot of success, and on the back of that, last year we launched our second European fund, which is the one I want to talk about today. Next slide, please. So this fund is called the SLM Silva Europe Fund. It's a real asset strategy investing in land and trees. We are investing across Europe with a focus on Ireland, Spain, and Portugal. The target AUM for the fund is 250 million euros. We had our first close last year, and we are continuing to fundraise this year and into the next. We're targeting an 8% IRR. And one thing to mention is that the fund will be climate positive because the assets are sequestering carbon in the trees and the soil. The next slides gives you a sense for the type of assets that we're looking to buy for the fund. So the overarching theme is productive tree systems. And so it's a mix of forestry and tree-based agriculture. The first bucket is forestry in Ireland and Spain, producing timber, which includes high quality wood product that can replace less sustainable construction materials like concrete. The second is orchards in Spain and Portugal, producing nuts, almonds, walnuts, pistachios, olive, all things contributing to a healthy, nutritious, plant-based Mediterranean diet for which demand is growing. And the third is agroforestry. Here we're specifically looking at cork oak systems. Cork is a really cool product, one that is renewable and that has a lot of different types of use cases, especially as we move towards more circular economies. So from a portfolio construction standpoint, we're offering investors diversification across countries, microclimates, and across different crops and different commodity markets. Now, on top of that, the fund can also offer exposure to carbon credits because there is carbon sequestration happening in the trees and in the soil, on the land that we manage, and we will be managing for that and accounting for it. That leads me to my last slide. And here I want to highlight the specific impact metrics that we've set ourselves up for this fund. So these are written out in our LPA agreement. We're committing to reporting on them throughout the lifetime of the fund to give transparency as to how we're progressing on them. The first target is around carbon. So we want all of our assets to be climate positive. Another way of saying that is net negative carbon profile. So the emissions from the operations have to be lower than the carbon sequestration that's happening both in the trees and in the soil. The second target is on biodiversity. Now, biodiversity is a tricky and expensive one to measure. But one thing that we can easily do is set some land aside specifically for biodiversity. So at least 10% of the land that we manage will be dedicated to biodiversity, and it will be managed to promote more biodiversity, such as building pollinator habitats and riparian areas. Now, one key thing to mention here is that we also think about biodiversity within the productive areas of a farm, not just the side non-productive areas, but this metric doesn't capture that. Then there's also metric around the number of jobs, but that will vary depending on the type of properties that we end up buying. And then we have some forestry specific targets. We are committed to being 100% certified on the FSC or PEFC, but most importantly, we're going well above and beyond just these certification standards because we're doing continuous cover forestry. And so we're committing to at least 65% of our forests to be converted to continuous cover forestry by the end of the fund life. On the agricultural side, we will be tracking soil organic matter. So soil organic matter is an indicator of soil health, and it's a really cool metric because it gives a lot of information. Higher soil organic matter means more carbon being stored in the soil. It also means more life, more microbiology, and more biodiversity. And it also means better soil structure with better water infiltration and retention in the soil, which is key for water management. And in order to increase soil organic matters on farms, you have to be applying regenerative agriculture practices, such as cover cropping, reducing tillage, reducing chemical usage, applying compost. Now, the other objective on the agricultural side is getting certified organic so that we can access premium markets to sell the produce. And so we're committing to having at least 75% of the land certified organic. And finally, we will also be tracking water usage on the irrigated land that we manage. So I'll end there. Hopefully that gives you a good sense for what we're aiming to do. It's really about keeping agricultural and forestry land productive because we depend on these resources, but changing how it's being done. Today, most of these land systems are a part of the problem, but they can be a part of the solution if we start to manage them with a deeper and more holistic understanding of what it means to be a healthy ecosystem. Thank you.
Thank you very much, Alessia. That was a great presentation. Very inspiring. We will move on to the next speaker and then come back to, I'm sure that some of the investors have questions regarding these impact statements that you've made and also how you're going to generate your returns. Christoph, you're next. You have the floor, please.
Yeah, hello, this is Christoph speaking. I'm just wondering whether that's the presentation that I looked at, but you know, we kind of reformatted. Yeah, that's excellent. Just kind of go to the first slide, please. So, yeah, exactly. So the Big Day Timber Fund, that maybe a bit the behemoth in the room, was launched in 2008 as the first and still only actively managed fund of its kind, with the aim to invest in the timber value chain. I would like to show you just a couple of slides here to give you an idea what this fund is about and why it might be interesting in terms of biodiversity. The first slide, please go back one slide, please. Yeah, so the first slide I would like to show you is about our sustainable investment commitment so that you have a clearer idea about what we do in this fund and even more important, what we don't. We believe that some forests should never be touched because of their uniqueness and their high biological value. But many forests out there have been managed by humans for centuries, and we should allow for these forests to be managed sustainably in the future, because wood is the only renewable and scalable raw material we have at hand, and that can really help us reduce our dependence on fossil resources. We do not invest in ecologically sensitive forest biomes or in countries or regions where the forest legislation is too weak or unable to guarantee the integrity of the forest. And last but not least, the forests and plantations our companies manage or from which they source their wood are to the largest possible degree certified according to internationally recognized standards such as FSC, PEF, SC, or SFI. Next slide, please. There is a concern that cutting down trees can only be bad for the climate, but this is a misconception. First, in sustainable forestry, and this is what this fund is about, 2 to 3 young trees are planted for each mature trees which is removed. What you see here is a schematic representation of a managed forest on the left and an unmanaged forest on the right. From a pure carbon perspective, the case is pretty clear. In a non-managed forest on the right, the buildup of carbon levels off at some equilibrium point when the old trees die off and are replaced by young ones that can grow into the gaps the dying trees leave. If we look at a managed forest on the left, we would regularly harvest and replant, so 2 to 3% of the entire surface per year. And as younger trees grow faster than older trees, and you add to this the substitution effect that you can get by using wood products instead of steel, concrete, or plastic, we get to an overall carbon removal or avoidance, which is several times that of an unmanaged forest. And it is accumulated over time. To be clear, as we have mentioned on the previous slide, we are not making the case here for taking all natural forests under management. We are just saying that from a carbon perspective, a managed forest is actually more beneficial. Can go to the next slide, please. But how does this look like from a biodiversity perspective? Let's have a look at this slide. Forests are home to maybe 2/3 or so of the terrestrial biodiversity. And this also holds for sustainably managed forests. We have 2 axes on this slide. The horizontal axis is biodiversity and the vertical axis is carbon sequestration and substitution. And yes, as this conceptualization suggests, there is indeed a trade-off. As any human intervention interacts with the natural state ex ante. The more intense the land management, the less biodiversity is left. We can understand that intuitively by looking at the left lower side of the chart. Intensively managed agricultural land can produce several crops a year, but this is only possible because we have hugely reduced the original biodiversity on this plot of land. Of course, build-up surfaces like roads and infrastructure are even worse. So for the Timber Fund, we have defined a range of acceptable trade-offs in the upper right corner or the upper right quadrant. This is what we would consider investable sustainable forestry options. There is a gradient even within that quadrant in carbon benefit and biodiversity. Most managed forests in Europe are quite close to the natural state, while forests in North America and more so in the US than in the Pacific Northwest are more productive, but also less biodiverse as time from planting to harvesting recedes. The limit for us are the fast-growing pine and eucalyptus plantations in the Southern Hemisphere, which make up only about 5 to 10% of our strategy. These plantations have indeed a limited biodiversity value themselves, but the fact that you can produce a lot of wood on a very limited surface allows for totally protecting natural forests that would otherwise come under pressure. We would also have here, all to the right, an untouched forest ecosystem. Such a forest corresponds by definition to the maximum status in biodiversity, so the natural state. But then nature can be cruel at times, and such forests do regularly succumb to catastrophic fires, which can then destroy much of the biodiversity in place and also release huge amounts of carbon. Eventually, as this circle suggests, these forests will grow back, but it can take a very long time. That is, by the way, another advantage of managed forests. They are much less prone to burn because the buildup of dry material on the ground is greatly reduced. To the next slide, please. In order to measure the environmental impact of our theme funds and of the timber strategy as well, we have come up with a proprietary method based on the planetary boundary framework. For those of you who are not familiar with it, the PB framework is a scientific framework which has defined 9 critical environmental boundaries, from climate change to biodiversity and other inputs that humans should never transgress, lest they would be faced with non-linear and irreversible consequences. I will just briefly touch on 3 boundaries here, which are particularly noteworthy. The first in the top left corner is climate change. Due to the primary sequestration of carbon in forests and the substitution effect, the fund has indeed a negative carbon footprint, meaning that investing in it actually removes carbon from the atmosphere in a cradle-to-grave perspective. This result is consistent with recent published studies, such like the one from Holgreen, which found that the European forest industry compensates roughly 20% of all fossil CO2 emissions in Europe. And then land use in the middle to the right stands out as an outlier. This fund has much larger land use than a conventional equity investment. This is not really surprising, as trees need land to grow. But we have to know that here land use is a pure quantitative figure. It does not say anything about the quality of land use. But as we have seen, forestry is probably the least intrusive and the most reversible human land use, and managed forests harbor still a lot of the terrestrial biodiversity. So having a large land use in this case is rather a good thing. And this takes us to the last boundary at the bottom to the left, the one on biodiversity. Species extinction is only observable over very long periods of time. So in this model, the biodiversity footprint is calculated using other factors and other inputs which are known to impact negatively on biodiversity. The most input variable is land use, but then also climate change, pollution, and other negative environmental influences. Because the land use of forestry is very elevated, the resulting impact for biodiversity is actually grossly overstated, or at least extremely conservative. But despite the large land use, the biodiversity footprint of this fund is quite a bit lighter than a conventional equity investment in the broad market. In reality, sustainable forest management is the best protection against deforestation and conversion of biodiverse forest land to other land uses, which might be very destructive to biodiversity. So I would think, looking at the time, that's it. I will not touch on our method. The next slide, maybe just briefly to profile the fund along the dimensions of sustainable development goals. And I will not comment either, that's the next slide, on the financial performance of the strategy, except maybe for mentioning that the fund has done very well over the last 3 years as investments in timberland. As investments in timberland have provided protection against inflation, and many environmental initiatives worldwide, from low or negative carbon investments, greener buildings, and replacement of plastic packaging through paper-based, have started to validate the underlying thesis of the fund. Thanks a lot for your attention.
Thank you very much, Christoph. Appreciate the presentation. All right, we've got about 10 minutes to go in Q&A. We already have 2 questions from the audience in the chat. So we'll go straight to the first one from Olivier Bourseau. Thank you for the question. It's addressed to Carlota about 6 KPIs. The 6 KPIs, if you can mention a bit more about that, and how do you get to 400,000 hectares of forest protected, in particular with regards to the Mayfreak cattle investment. Carlota, if you can. Thank you.
Yeah, sure. Maybe I can answer also to the do no harm that you asked and link it to the KPIs.
Sure, yeah, absolutely.
Yeah, so on the do no harm, we basically assess it prior to our investments. So we have a forest and biodiversity framework, which assesses the baseline situation of the forest, what harm has been done so far, and what harm can potentially be done with the current business practices in the future. And we ensure that the approach that we define doesn't do any further harm, and that is net gain in the process. We then verify in-house. We have a close relationship with the client. We go to the site visits 2 times per year, and then there's a third-party verifier on all the KPIs that we define. So in terms of the KPIs, we have 6 headline KPIs. The first one is the forest protected. This indicator measures protection of threatened species and biodiversity, particularly high conservation value forests near projects. We also have climate benefits. This indicator measures emissions reductions generated from change in farm management practices and sequestration generated from regrowth and densification in degraded forest. The third one is ecosystems with improved resilience, in which this indicator measures the improvement that rehabilitation, restoration, and protection of forests and regenerative agriculture practices provide to the ecosystem. And the fourth one is people with increased resilience, measures the number of individuals for whom a benefit or service is being provided or made possible. People benefiting is more broad, is the number of individuals benefiting from secure land tenure agreements, jobs supported, gender, etc. And then capital mobilized, that would be the last one, measures the capital that is catalyzed by green investments and any additional funding. Worth to mention that within each of these 6 headline KPIs, there are operational indicators and specific KPIs that we have on our website in case you want to take a look. For each investment, we decide which indicators are more suitable to evidence and track the transformational change of our investments, and specifically for Marfrig, that was your question, Olivier. The way we secure forest is at a supply chain level. They need to comply with a no deforestation, no pit, no exploitation policy. For that, we have created a roadmap to roll out across their supply chain and reach out to almost there are 90,000 suppliers, because we include also the indirect ones. And currently, we are 1.5 years into the loan, and they're currently mapping all of these suppliers to reach full compliance by the end of the loan tenure. For Marfrig specific numbers and KPIs, we are releasing our annual report end of this week, beginning of the next one, and you will have all of the data there, as well as the backup for the 4,000 hectares that I mentioned.
Thank you so much, Carlota. I wish we had more time to go deeper into your answers. We have another question for Alessia related to real assets and their vulnerability to issues like climate change. How do you manage that sort of risk?
Yeah, of course. We're sort of first line exposed to climate risk and more broadly natural capital risk. But I'd say there's mainly sort of 3 things that we do. The first one is the importance of being able to diversify across microclimates and across countries. But even within one same country, there are a lot of different microclimates, and even maybe 2 farmers that are near each other, but at different altitudes, one might have a good year and a bad year on that same year. So diversification is key to manage that risk. The second thing is it's still really important to be picky about where you invest. And so we leverage climate models where possible, research, government databases to get better insight into fire risk, drought risk, storms. One example is Spain, where we're looking at forestry in Spain, but obviously fire is a big risk there. And so we're very careful. There's a lot of areas that we wouldn't approach. But there are some places where we think the risk is manageable. And then finally, we can increase the resilience to climate change through better management practices. And maybe just to bring it to life, I'll give one example for ag and one example for forestry. On agriculture, better soil management goes hand in hand with water management. You can increase the soil's ability to capture and retain rain when it does rain. And that way you avoid flooding, you avoid the water running off when it rains, but you actually can keep the water in the soil on your farm for longer. A healthy soil can act as a sponge, which is key to manage the world where we're going into, where it's going to be a lot of rain with a lot of dry spells in between. On the forestry side, the continuous cover forestry systems that were implemented are showing more resilience to climate change. And one thing I'll mention specifically is pest. A continuous cover system is more diverse in tree species and tree age, and so it makes it less vulnerable to pests compared to a monoculture plantations where all the trees are identical and of the same age. The other thing is in a continuous cover forestry system where you're allowing the trees to grow for longer, you're also allowing trees to have deeper roots, and that makes them more resilient to wind throw and storms. So those are the things that you can do to small management changes to increase resilience.
Thank you, Alessia. We're running out of time, so just a couple more questions for each of you. But before that, I think there's a hand raised from Juliette Chevalier. Juliette, do you have a question? Or if not, I had a question for Joseph. Can you tell us in just a minute what the nature of the partnership with the African Wildlife Foundation is? I think you had it in one of your presentations for TA.
Yes. Indeed, thank you. Yeah, the African Wildlife Foundation is an organization based out of Nairobi with very strong links to the community side of working in wildlife conservation. And we developed a partnership by which they have a technical role. So they're sort of shareholders, but without economic rights or voting rights in the GP, but that they have a role in our impact committee that also allows them or justifies them allocating resources in the form of biologists, GIS, geographic information systems specialists helping us map impact in terms of biodiversity and climate across our pipeline of potential investments and around our portfolio, which I think Alessia mentioned, right? Biodiversity monitoring is very expensive and very complicated, so that's an invaluable partnership in that sense.
Tim, I think you're on mute.
Oh, my apologies. I was indeed speaking to my computer. To the fund managers, if we could just have a reminder of the domicile of your investment vehicle, as well as how much you're looking to raise, and the average ticket size or target ticket size, and the target return. If you could just go quickly through these 4 items for the audience before we finish the call. Starting with Carlota, perhaps.
Yeah, so our fund is domiciled in the Netherlands. We are aiming to raise up to 1 million. We have raised 180 million so far. As it's a blended structure, we're aiming to raise 400 million from public investors and 600 million from commercial, but the first commercial fundraise is just 250. The minimum ticket size is 25 million. The instrument is a note with a tenor of 10 years and a targeted IRR of 6%.
Wonderful, thank you. Joseph.
Our fund is a LPGP structure out of Luxembourg, an SCSP. We are raising 75. Minimum investment ticket is 500,000, and we are targeting net IRR of 15%. Thanks.
Thank you, Alessia.
Yes, so the SLM Silva Europe Fund is an Irish limited partnership. We're targeting an 8% IRR. It's a 10-year closed-end fund with a possible extension of 3 years, targeting 250 million euros. We've raised 17 so far. Minimum ticket is 5, but flexibility around that.
Perfect. Thanks, Alessia and Christoph.
Yeah, the fund is a Luxembourg UCITS fund. It's a mutual fund, publicly listed. It exists since 2008, so it has already quite a size. It's 1.7 billion in US dollar in assets under management, and there is actually no minimum kind of hurdle to invest. It's just kind of one share of the fund, you know, 250 or so dollars, and so the return is we want to kind of to beat the broad market, the broad equity market over an entire cycle. So an up and a down cycle, and we have been able to do that since the launch of the fund.
Thank you, Christoph. I think I saw on your slide, it went by very quickly on the financials, that you had an average return since inception of about 10 or 11%. Is that fair?
Might be about the case, yeah.
Yeah, with the volatility about 20%. Great, thank you, Christoph. So my thanks to all the fund managers for presenting their products. I think to the investors on this call and those who will watch it later, you can see that there is a wonderful range of strategies for the same theme. It spans multiple asset classes from debt to equity, mezzanine, and listed securities. It spans different geographies as well. We've got Europe, we've got the Americas, we've got Africa and Asia, and a wide range of returns too that are related to the profile of risk. What I like about each of these funds is that they're also quite innovative in their structure, in their strategy, in their impact measurement and reporting. And I think that you're the tip of the spear when it comes to mobilizing capital for biodiversity. So again, my thanks to each of you for the wonderful work that you do, the products that you bring to market. And I'll finish with an invitation. We have the Building Bridges Conference in the first week of October in Geneva. You can find more information under www.buildingbridges.org. And it would be a pleasure to see all of you at that conference, where we will try to mobilize more capital for the SDGs. So my thanks to each of you, and have a good day.
Thank you very much.
Thank you.
Thank you. Thank you.
Bye.